This is the Legacy Wealth Code Podcast, helping you build long-term wealth and a lasting legacy through real estate investing, tax strategies, and motivational stories from some of the most successful and influential people out there. Here are your hosts, real estate investor and entrepreneur, Michael Notbaum, and real estate investor and attorney, Andrew Hook.
Hey guys, welcome to another episode of the Legacy Wealth Podcast. My name is Michael Notbaum. I'm here with my partner, Andrew Hook, and super excited about today's episode. We're going to discuss just really the real estate market as a whole from an investment standpoint, moving into 2023. We've got a great guest with us today, Chris McLaughlin. So Chris began his remarkable career as a founder and president of smartportfolio.com, an online newsletter company which sold December 2000 to thestreet.com. Currently he owns 4 Keller Williams offices located in Lakeland, Winter Haven, New Tampa, and downtown Tampa Channelside District. Collectively, they have 914 agents, ranked in the top 10 by Florida Real Trends, and his office closed in 2021, $2.2 billion in total sales. Chris is also the founder of Loss Mitigation Training Institute, LLC, which focuses on distressed real estate market and pre-foreclosure training. Chris authors a free daily update on the real estate industry that has over 75,000 subscribers. His book, Chris McLaughlin's Guide to Smart Real Estate Investing, was the top seller in the business category on the New York Times bestsellers list. A graduate of Georgetown University in Washington, D.C., where he was elected student body president, he obtained a law degree and an MBA from Georgetown. And Chris is an active member of the Florida Bar Association. Married to Brandy and has 5 children. Thank you so much for coming on today, Chris. It's an honor to have you.
Good to be here, Michael.
So super excited about getting some insight from somebody that has such an incredible background. $2.2 billion in total sales from a retail perspective is definitely, a huge feat. You think of it from a real estate agent standpoint, a guy sells $5 million a year and he thinks he's an all-star. And, you got $2.2 billion.
You definitely don't do it alone. Nobody succeeds alone. So we've got a great team, and we're actually, the bio that you read was just a little dated because we're up to about 950 agents now. So We're growing in a shifted market, which is kind of unusual for real estate offices to do. But what's happening is people are at other offices and they're thinking, oh my gosh, the sky is falling. And so they're wanting to kind of have shelter in the storm. And so they look to Keller Williams as a big name, and with our training and everything to get them motivated again.
Yeah, sure. Well, I can certainly attest to the training at Keller Williams is top notch. Yeah. I've known you now for 5, 6, 7 years. And I know you got started with the loss mitigation training. So You've gone through these shifted markets before.
Sure.
What do you think the similarities are with this market versus, 2008, for example?
Well, let's take a look at 2008 because there's a big dissimilarity, which is the credit worthiness of the borrower. So in 2008, you had ninja loans, no income, no job, no asset. Hey, you get a loan. No big deal. Everybody gets a loan. It's like Oprah giving out keys. Everybody gets a loan. Everybody gets a loan. I remember, and I have most of my properties in a portfolio loans with local banks. We can discuss that later in the podcast, why to do that if you're a serious real estate investor. But we had Countrywide Home Loans at the time in-house with us at the Keller Williams office in Lakeland. I remember walking down the hallway and I said, hey, can you get me a loan? And just kind of teasing. They said, well, what do you want your income to be? I was like, wow, this is crazy.
What could go wrong here?
What could go wrong here, right? What you want your income to be? Oh, I don't know. I'll just make something up and commit mortgage fraud. I don't know. But 2008 was a very, very unique set of circumstances because ultimately mortgage-backed securities, they couldn't value them because there was so much fraud in the system. And so they just had to kind of unwind a lot of stuff. And there was, of course, massive amounts of foreclosures. You had Lehman Brothers failing. You had economic times that were unparalleled in our nation. So it's called the Great Recession for a reason. It was a Great Recession. Really, for real estate, it was a depression. And so in 2008, 2009, I kind of recognized that. And I said, well, gosh, I could put a couple skill sets together. One's that I'm an attorney, and then the others that I'm a real estate broker. And I could say, hey, let me go and teach people how to take advantage of a market like this and flip short sales. And so we became really recognized all throughout the nation for flipping short sales. And one of the folks here in Tampa was Nathan Jurwitz, who's my business partner on the thing. He was called the Short Sale Kid. And so he got a lot of notoriety because he was a kid, or he looks like a kid. He was actually a little older than a kid. but he got a lot of notoriety just because he had crazy hair and he'd drive around in Lamborghinis and he would make a lot of money. We had a lot of fun back in 2009 and 10 when we were selling these courses and doing huge conferences in Los Angeles and Vegas and everywhere else. But that's a big difference between what we see now. Okay, so what we don't see right now are a bunch of uncreditworthy borrowers that are going to make strategic defaults. And what I mean by strategic default, they're just going to say, well, you know what? I don't know. I kind of bought this house. I'm $20,000 or $30,000 under on it right now. Might as well just stop making my payments because I'm underwater and it's probably going to be underwater. Well, in this case, what we've got now, of course, you do have some people that are FHA that are probably underwater, but the big difference is they have a low interest rate they locked into. And so they're not going to want to make that strategic default because all of a sudden, if they get out of that house and they've got let's say it's a 3.5% interest rate, they're going to be looking at over 6 right now if they want to buy again. And also, don't forget, right now in this particular market, the rental market is on fire. So a lot of people are going to rent, but they're also paying so much to rent. So rentals have been very parallel with the appreciation in properties. So you don't have quite the calamity that we saw in 2008, but what we have seen is we've just seen a major appreciation in real estate asset class.
Right.
Major appreciation over the last few years. So what I anticipate is that prices will start coming down. They can't go up forever as long as interest rates are as high as they are right now. So it's a function of the one's a function of the other.
You're limiting out the buyers that are, the same person can't buy that same house 2 years ago or now that they could maybe a year and a half, 2 years ago.
But what I will say is that because the Federal Reserve, in my opinion, is just wanting to stamp out inflation so much, and they're just going after it so aggressively, that they will force our economy into a recession. And when that happens, you're going to start seeing unemployment go up. And when unemployment goes up, you're going to start seeing more foreclosures and more short sales opportunities because ultimately people can't afford to be in their house. They don't have any income. And if they can't get a job. So that's what I'm anticipating happening over the next year to 2 years. So there will be some great opportunities to buy, particularly foreclosures that will be hitting the market, in short order with the Federal Reserve's wonderful aggressive rate approach. Because, think about this. We went from an interest rate of 3.25%, 3%, and all of a sudden within 12 months we have interest rates that are more than double that.
Yeah,
that's whiplash. Mm-hmm. And so you're going to see a lot of people just kind of thinking, well, this is just a little crazy. But here's the reality of the thing. The reality is that we had historically low interest rates. They never should have stayed as low as they did.
Right.
And so the average interest rate is more in the high 5s, low 6s throughout our national enterprise here. So it's not such a horrible rate when you look at it in the big term, but certainly you can feel the pinch because prices have gone up and interest rates have gone down. And so when that happens, there's that, your payment isn't that bad. Now interest rates have gone up and prices are pretty much stable right now. So something's got to give, in my opinion, in order to get the market moving a little more than it is now. And I think that's going to be prices are going to come down. So, and we're already seeing that. We're seeing that, it used to be a year and a halh ago, it was crazy. The market, it was, okay, let's offer $100,000 over, let's price and hope we get it. And we've got 15 other people we're competing against.
Right. Appraisal waivers. And,
no inspections and everything. So now what we've got is you'll have 1 or 2 offers and they'll be probably below asking. So the person that's on the buy side is going to get a discount on the property, but they are going to be paying a higher interest rate than they would have paid a year ago.
Right.
Yeah. So this is a crystal ball question, but what do you think prices are going to drop?
I think we could easily drop 10% without batting an eye. Do I think that they will drop 30, 40%? Probably unlikely because we have limited inventory still as well. The reason we have limited inventory is, think about it. You're in a house with a 3.1% interest rate and you're thinking of just kind of moving on up. Well, when you start looking at your payments, you're going to go from a 3.1 interest rate to a 6.25, 6.5, whatever it might be at the time. That's not something that people are going to be jumping in for joy to do. So they're going to just stay put. And so there's going to be a lot of people who are just staying put and they're not going to list their homes, even though they have a lot of equity in their homes. Mm-hmm. So, but I think, 10% would be very comfortable. The market wouldn't freak out about it. And we'd be able to move some properties with some discounts like that.
Sure. On more of a macro level, do you think that Florida is more insulated than other areas of the country in this?
Yes, we have. Well, my personal belief, we'll sell, just so you know, we sell homes to Republicans, Democrats, Independents, everybody. But my personal belief is that we have an economic situation in Florida with no income tax. We have a great governor, in my opinion, and we didn't lock down people like they did throughout the rest of the nation. So people have a natural affinity for Florida right now. And the economy in Florida is so strong that I don't think it's going to follow suit. But if I were a person right now and I had a lot of property in California, I'd probably be sweating a little bit. I'd be a little nervous because California has so much to go and to fall. Mm-hmm. And they have a horrible tax situation over there. And their politics are just all kinds of strange. So, California.
I've always wondered how, you go and visit, and I'll always pull up Zillow just to see what these houses are worth. And it's like $5 million, $6 million, $8 million. And then you got a local tax, a city tax, a state tax.
Yeah, it's never ending.
Yeah.
The DMV to register your car is probably amongst the highest in the country.
Well, and
property taxes are insane.
You see these celebrities like Mark Wahlberg moving to, I guess he went to Vegas, and you got Elon Musk taking Tesla out of California and moving to, I think he moved to Texas.
Texas, I think, yeah.
So, so there's just a movement away from California, and but California, it's got great weather, mm-hmm. So you can't knock them. They've got great weather. There's a reason why people want to be there, and it's typically the weather. Here we have a lot of humidity in Florida, but that's okay. I'll take a couple $1 million more of equity with a little bit of humidity.
Sure.
So for investors, maybe they're seasoned investors, maybe they're newer investors, but what do you think the best opportunities are going to be in the next 12 to 24 months?
Sure. I think going direct to the seller who's in financial straits, who's got a foreclosure pending, is what I would be doing, and is what I'm going to do. So I'm going to be doing postcard campaigns to foreclosure lists, to what we call NOD lists, notice of defaults. So somebody has a notice of default, or there's also pre-NOD lists out there which are a little sketchier. They're not necessarily available to use legally. So I'm not recommending that to your viewers or your listeners, but the NOD list, the notice of defaults, that's just when a les pendens been filed on the property and they're indicating that it's headed to foreclosure. And I think there's going to be a fair amount of foreclosures hitting, but I don't think there's going to be a ton of short sales, to be honest with you. And the reason why is I think there's a lot of equity out there. And so people that are in foreclosure are still going to be able to look at their loan balance, and they're going to say, okay, well, my house is worth more than my loan balance, so I'm going to go ahead and try to sell this on the market, or just sell it for cash to an investor, or sell it, with a realtor.
Yeah, and we're kind of seeing that. We've done the wholesale thing for a long time, and when we first started doing it, we'd have our virtual assistant calling, and we'd like to make a cash offer, and they would say, "Oh yeah, I want $400,000, and it's worth like $180,000."
Sure.
So now all of a sudden those conversations are changing. So I do think that there's going to be a fair amount of opportunity there, but it's just been so crazy for so long that it takes a little bit of time, it seems, for everyone to kind of adjust to what the new reality is.
Right. Yep. Absolutely. And don't forget the other thing that we didn't have in 2008 were these crazy rent prices. So rents were relatively reasonable in 2008, and you could go rent something. Right now, people are having to really do the analysis and say, gosh, if I give up on this house, I'm going to have to go pay $2,500 a month in rent, and my current payment is $1,700. I'm just going to stay where I am. I'm just going to try to make do. So that's why I think you're going to have a little less. You're going to have less what they call strategic defaults. People are just making the analysis, saying, "Look, I'm underwater. This isn't a good investment for me anymore. I'm just going to bail."
Yeah,
I think you'll have less of that.
When you think back to 2008, Airbnb wasn't there either.
Yeah.
So if you are in a bad situation, you can Airbnb your property. You could go rent something and then probably be okay. Because like you said.
The short-term rentals are a huge impact financially and have made people a lot of money.
Yeah.
So.
No, absolutely.
Jumping back to interest rates for a moment. So the Fed made another hike recently. Mm-hmm. What do you foresee kind of Q1, Q2 going into 2023? Do you have a prediction on that?
Sure. Well, there's a guy named Rick Milton who's out of Chicago who's an economist I just listened to him speak a couple days ago, and he's a very, very bright guy. And what he's saying, and what a lot of the economists are saying, is that the interest rates are going to continue to probably hang around in the 6s. This is the 30-year fixed. Now, the 30-year fixed is tied to the 10-year Treasury.
Mm-hmm.
So when we hear the federal funds rate going higher, that doesn't necessarily mean that the 10-year Treasury is going to go higher. So people are kind of saying, oh, well, rates are going up because the Fed keeps on increasing rates. Well, that's true for consumer debt. That's going to be true for your credit cards. It's going to be true for like going out and getting a car loan, things like that, things that are tied to the prime rate, the rate that the banks charge their customers. But in this case, what we're looking at are mortgage-backed securities, and we're looking at a 10-year Treasury that's tied to the 30-year fixed. And what was interesting is that the Fed increased rates, but actually rates went down on the 10-year Treasury. And that's because I think people are thinking, okay, there is an end in sight with this. And so I imagine that the Federal Reserve is going to continue to increase rates up until probably June of next year. And then they're going to start looking at their data like they always do. And they're like, uh-oh, we overdid this. Uh-oh, we overdid this.
Whiplash back the other way.
Right,
They're going to be like, time to cut rates again.
Back to you get a car, you get a car.
Exactly. So there will be a lot of pressure on them because unemployment will start creeping up because ultimately you want full employment. But, when people start losing jobs, then there's the impact on the economy. But I'm already seeing it. Prices are coming down. They are coming down. They're not coming down necessarily in eggs and some of the consumer stuff that you get at the grocery store. But I mean, remember the run on Rolexes?
Mm-hmm.
And you couldn't go get a Rolex to save your life and everything. And you looked at the Rolex prices and they're crazy. Well, now if you look at the Rolex prices, they're not as crazy. And I think a lot of that has to do with the air that's been put out of the crypto balloon. So with FTX and Mr. Blankenfein-Smith or whatever his last name is, with all the fraud that's going on, people are losing confidence in crypto as really a safe storage of value. Yeah. And so they're losing that confidence. And so,
well, you think about how much negative publicity has been on crypto from day one, and then it just was able to rally through a lot of that. And then now this is like, wow.
Yep. And then what you've got is kind of a unique situation where you have both stock market and the bond market had a horrible year last year. And usually they're the inverse. Usually if the stock market has a bad year, then bonds go up. That's not the case last year. So if you had a blended portfolio full of stocks and bonds, you lost about on average 20% last year or this year. I mean, we're still in December, so I don't think we're going to see a massive turnaround. But we're looking out into, my crystal ball says that interest rates, believe it or not, could go below 6 in the latter half of 2023 because the Federal Reserve is going to take a more accommodating approach to trying to say that the economy is not going to go into a full-blown, bad recession or long recession or what have you. Instead, and then also I think that prices are coming down. I think car prices are coming down. Used car prices are coming down. Rolex prices are coming down. House prices are going to come down. So that's what the Federal Reserve wants. But they want to get it down to like 2% inflation, and that's a tall order. But if they could get it down to 3 or 4, then the folks that are so affected by inflation, which is the middle class and lower, really are getting hit the worst with it. Because they're the ones having to really stretch to make the gas payments and stretch to do all the things that buy the groceries and everything else. It's having a huge impact. They're going to be able to make it again. So because it's with inflation at 8-9%, and it's crazy. But we did get I think the last number was a 7.1 CPI, which was good. But the Federal Reserve, there's the old adage of don't fight the Fed. And so people are expecting the stock market to kind of be directionless and listless until the Fed gets into a more accommodating approach to the economy. So right now they're zoned in on inflation, and I think they'll be that way for the next 6 months. And then after that, they'll say, oh, we overdid it. And then they're going to come back and start cutting rates again. Yeah,
the stock market definitely seems to have not a whole lot of confidence in what's going on right now.
Right. It's all over the map.
Just too much uncertainty, I think.
Sure.
Yeah.
And, people right now it's December. So what are people doing? They're selling their losses, which is making things even go further. down because, I sold a bunch of losses yesterday, in fact.
Wait, you had a loss?
I had a loss, believe it or not.
It must not have been real estate related.
It wasn't real estate related, but I had some losses.
What was it you posted the other day? Your son won.
Yeah, my son won the Central Florida Stock Market Challenge. And, he's 18 years old, but he also competes against my 14-year-old. And they both have a brokerage account that I give them the username and password to, and they can trade all day long. It's not a lot of money, there's a couple $1,000 in there, but they have fun doing it.
Yeah.
They compete against each other. And
what a great learning
it's great learning experience.
Yeah.
And it's real money. So it's like they lose real money. And I'm like, oh, but I told them yesterday, I said, you guys got to go sell your losses. I said, it's tax time for Dad. So I gotta keep my taxes billed as low as possible.
That's funny.
So
what does your portfolio look like right now from just your real estate investments?
Sure. I've got 70 single family homes that are getting close to being paid off. So that's always a nice thing to have. Built a lot of equity, and I bought them cheap. So I bought 50 houses between 2009 and 2010.
Wow.
And,
I remember you telling me that.
Yeah, these are prices. I'd get the prices at, $55,000, $45,000. And what was crazy is just, you've got to remember it's the old Warren Buffett, be greedy when others are fearful and fearful when others are greedy. And I remember when I was buying these, people thought I was crazy. I was like, you're crazy not to buy these. I can go and rent them out for $1,000 a month all day long. And I'm owing a couple $100 in my PITI payment, my principal, interest, taxes, and amortization. So it's like, what? You're crazy not to do this.
So these 50 are this is the portfolio loan that you're talking about?
Yeah. So ultimately, it makes a lot of sense if you're going to start buying more than 10 units, because 10's your top with the Fannie Freddie and all that fun stuff. So what I do is I go to the bank. Well, let me just back up a little bit and just kind of tell you what I did. So what I did is I went to the bank and I said, hey bank, let me get a line of credit for like $500,000. They're like, okay, here's your line of credit for $500,000. Now I do have, I'm not your typical borrower, so I have a good strong income, a good tax return. I pay taxes and everything else. So not everybody's just going to walk in and say, hey, I want a $500,000 line of credit. Particularly after 2008, 2009, they're ratcheting up and they're going to want to say, oh, well, what's the collateral? But regardless, I got a line of credit. And then I went and I said, okay, I want a directable amount of money that I can just kind of have as a big pot. And I think it was $1 million at the time. And my goal is I'm going to go buy properties for $50,000 a pop in cash. And then I'm going to go renovate them for about $20,000. And then I'm going to go ask for my after repaired value, my ARV. I'm going to ask for a 75% LTV on the after repaired value. So if you take a $50,000 house and you put $25,000 or so into it, it will appraise for about $100,000 or $90,000. So look at the math. Just do the math with me real quick. If I put 50 in, I bought it for 50, I put 25 in, I'm at 75. Well, my ARV is probably 100. Then I go to the bank and say, give me 75% LTV. They're giving me back 75,000. What did I put in? 75,000. Mm-hmm. Rinse, repeat, rinse, repeat, rinse, repeat. So you can do that stuff without having to use a lot of cash because you're creating real value. Now, that was also a different time and place, and we're not going to see prices go down to $50,000 that often.
Yeah, at least not in this area.
Yeah, not in this area, not in Florida.
Were you buying those in bulks or were those one-offs?
Those were one-off. Those were directly, a lot of them were directly from the foreclosure auction. Okay. So I would go down to the foreclosure auction and bid and bring cash with, the cashier's checks and do all the fun stuff and do all that. And then they made it more fair and they put it all online. And so with it being online, particularly in Polk County, that's where I buy most of my stuff. With it being online, it was the ultimate equalizer. You couldn't have the people trying to intimidate you not to bid and all that kind of stuff. And
they bring their enforcer with them.
Oh yeah, exactly. They'd be like, "Don't you bid on my properties?" You don't even know who's really bidding because it's all bid numbers. You have to go do a bunch of research and figure out who they are. But anyway, so we bought some short sales, but mainly I bought a lot of foreclosures from the auction steps and really just great cheap prices. And I wouldn't even inspect them because I'm like, if I'm buying for $50,000, it really doesn't matter what's the problem with them. I can fix it, and it's still going to make sense. So do
you have like, I know when we were looking at properties, it's usually like pre-1980.
Yeah, what's my buy box?
Prefer a block home.
Well, I had a buy box at the time, and then all of Wall Street kind of blew my buy box up because I wanted
open door.
Yeah, exactly. Well, everybody came in, and particularly it was Blackstone at the time, came in and started buying up, and Americans, the other ones, It slips me right now, but Colony bought up a bunch. So anyhow, some big Wall Street, New York money came in and started buying up the foreclosures in our area too, to rent them out long term, which, actually really helped stabilize prices quickly and got, so my properties are worth even more now because you've got these hedge funds still holding their properties from the market. But in general, I think we've got a great opportunity ahead of us, but we're not going to see the prices like that we saw in 2008, 2010. It's going to be very unlikely that we'll see those kind of prices. And but the portfolio loan, you just go to the bank, and I said, I want $1 million directable line. And so what I would do is I would just go to them, and you wouldn't have to underwrite every single file. I was just already underwritten. Mm-hmm. And so they would just say, okay, here's Chris's next property he bought. Here's, 75% LTV, and move on to the next. And once I got to $1 million, then I just did it again. And, and so bought a couple $1 million worth of properties, which are worth a heck of a lot of money right now.
Yeah.
But also, I have some commercial properties as well in my portfolios. So I own 3 of the 4 buildings. I have partners on them, real estate agents that are partnering with me on the buildings, 3 of the 4 locations that I've got for Keller Williams offices. And then I've got a little daycare that I own as well. Not the operating business, but the actual building.
Yeah, the building.
And what's kind of cool, to be honest with you, is I'm starting, I'm 49 years old, and some of the deals I did back in the day that I did, seller financed, I just had one, 450 First Street over in Winter Haven. It was a seller finance deal, and I've had it for 15 years, and all of a sudden I'm sitting there looking at my last payment that I made on it. I'm like, hey, this is pretty cool, you're living the American dream. You're going to be, this thing's going to be cash flowing even more than ever was.
Yeah.
And then I could tap that equity if I wanted to and go and buy more. And so there's a lot of opportunity with when it's not timing real estate, it's time in real estate. And I really believe that. I think people get too caught up in, I've got to time the market. Well, anybody who tried to time the stock market this year is probably not feeling very good. But you kind of just dollar cost average in the stock market. And you also, with real estate, it's just like, as long as you're making good cash flow after your rent that comes in, and you can pay your debt payments and everything, I always call it the rule of 1%, which means that 1% of your purchase price should be your monthly rent. So if you have a $200,000 home, roughly it should rent out for $2,000 a month. That's just an easy rule of thumb.
Easy way to underwrite them.
Yeah, easy way to just kind of do a back of envelope, analysis. And a lot of people unfortunately didn't do that. But now you do have short-term rentals available, so it kind of throws that a little bit, because you'll get more cash flow on an Airbnb with a lot of properties if you know what you're doing.
Yeah. Well, and and I love Airbnbs. It's a big initiative of ours for 2023, but it's one area to the next. It's like governments, local governments. I was watching the news the other day, and I think it's Madeira Beach, where right now you can do it, and they have people just, every day lobbying to the city council, and I get it. In some ways, it's like, if I had a multi-million-dollar house on the water, I don't want a bachelor party every day next door. So, I think it's on the people that own them to make sure that that's not, not happening. Sure. But that's the only fear I think, I feel
is the regulation. Sure.
You might have something, and that's where
we got that 1%. Over in Lakeland right now. Well, you should always be able to make the 1% work.
Right. As a long-term.
Yeah, as a long-term play. So any Airbnb, I always say, make sure you can still rent it out long-term. But then, if you want to juice your cash, then to do Airbnb or VRBO. But
I guess, Lakeland probably gets a ton of that from Disney World and all that stuff too, right?
It's a good Airbnb market over there. Actually, there's an agent, Daryl Ash, that does a lot of Airbnbs with us, and he's pretty good at it. So what you're finding is, and this is kind of an interesting way of, if you didn't have a whole lot of money and you wanted to do Airbnb, then as long as they will essentially subordinate the lease to you, you can essentially go in or sublet the lease. You can go and rent the property,
right,
and then go essentially sublet it for more, and then you've got it during that term, and so you're arbitraging. It's kind of Airbnb arbitrage. And Daryl does some of that right now too. So he's kind of the man over in Lakeland doing Airbnbs.
And so when he's signing a lease with them, it just explicitly details that he's
right. He has to tell them that he's doing Airbnb.
Right.
Yeah. Mm-hmm.
Yeah. I mean, I think that there's, like you said, if somebody's just getting started, doesn't have a whole lot of cash, that might be a good way to.
It's a good little way to do it.
Chris, we talk to people on here that take the opinion of, either we will buy, hold for a short duration, resell, replenish, that type of model.
Sure.
Or
method or
or they'll say, we can name on one hand how many properties we've sold in 30 years. Where do you fall in that spectrum? Are you do you ever sell? Do you sell strategically? What does that look like for you?
It's really interesting you mentioned that, because I had a property 455 North Tennessee Avenue. It's a multi-use facility. It's got offices on the downstairs, and it's got residential up top, and it's about 9,000 square feet, and I bought it for $900,000. So I bought it, roughly $100 a square. So I got a good price on it. But it's the headquarters of my Keller Williams offices, or some of the agents have their teams in there.
Mm-hmm.
And so I was looking to just do a little quick home run. I bought it a couple of years ago. Downtown Lakeland's on fire right now. And it's like, you know what? I think I'll just go take $1 million off the table and go sell it. And so I had an offer at $1.8 million. I had a verbal offer at 1.8. But then the more I thought about it, I was like, what am I doing? I was like, I don't want to sell this thing. This thing's downtown Lakeland.
Mm-hmm.
This is gold. So instead, I just did a cash out refi. And so I just, I had a couple of agent investors in the property with me. And so we went to the bank and we threw a second mortgage on the property. And everybody got the money tax-free to them, of course. And then, of course, they'll, we'll have to deal with tax implications whenever we sell in the future. But what I can tell you is refinancing and pulling the equity out is always a better option than selling when it's your property. But when you are, needing the cash flow and you're needing the cash, sometimes you sell. Unfortunately, in my circumstance, the other issue I have is that I'm very actively involved in the management of my properties. So, and I'm a realtor and I'm a real estate broker. So I get to take my depreciation against my ordinary income.
Mm-hmm.
Because my income is, K1s from real estate offices and all that. So the benefit of that, of course, is I have right now I have about $200,000 in depreciation I can take against my ordinary income every year. So that's a nice tax break. The downside of that is that if I sell something, I'm not going to get the capital gains treatment on it. It's going to be considered ordinary income. So if I sell a property, one of my 70 houses I own, if I sell one of those, it's going to go into income as opposed to capital gains. So that's not necessarily something you want to do.
Right. So
my goal would be just to keep these properties, and it's more of a legacy to my kids and everything else.
Sure.
And so they're starting to learn about it. My oldest son was a intern for our property management company last summer. And so I take them out to real estate conferences. I want them to know that, hey, they've got a piece of that. And actually of the 70 I own, 6 of them are actually owned. I control them through a trust, but 6 of them are the beneficiary are my kids. They own 2 properties each, and it was 100% financed. So I bought them for like $50,000 each, and threw the 20 into it in repairs, and so we're in it for about 70. Now they're almost free and clear, and I've already earmarked them for college. I was like, look, this is your college. You can go refinance these, pull the equity out, tax-free, pull your cash out after you refi them. Or you can sell them if you wanted to, whatever. But by that time, you're going to be an adult, 18, so it's not going to hit my tax return.
You're not hitting
my tax return, so you hit your tax return. And so they wouldn't necessarily have the issue of having the properties have to be taken into income anyway. So, but yeah, those are their colleges paid for with, they all have at least, $500,000 of equity minimum right now. And it was created back in 2010. I think I bought the properties for them.
That's awesome.
Yeah, really great situation where, of course, I did the 529 plan and all that, but my 529 plan is down like $100,000
right,
because of the stock markets being down so much. So my properties are just keep on keeping on. And sure, if we lose 10% of the value, don't forget I've also got great rental income on them, and I'm paying down the debt on them. So they're almost free and clear.
So what do you think, because we talk a lot about legacy, what do we want our legacy to be? What do you want yours to be?
Sure. Well, I want my, this is a little personal, but I want my net worth to be over 100 million. So that's kind of one of my goals.
I remember we were having that conversation while we chartered a private jet to New York. So I can tell you that he's well on his way.
That's funny. That was a good trip.
That was a good time.
So it was a great trip.
From 38,000 feet, he's telling me this. I'm like, well, I think you're on the right track.
All I know is Michael started gambling on the flight. And I just said, Michael, I said, I'm paying for this jet, and I'm not paying you any of my gambling losses.
It doesn't matter how
So I
much
was
you
like, I don't care how much you win. I'm not paying you anything unless you want to go in halvesies with me on this jet.
That's funny.
So anyway.
Go ahead.
No, I was going to say, so what do you see, aside from the $100 million, like what do you want from your kids? I mean, it sounds like you're on the right track.
Well, I want my kids, first of all, I want my kids to earn it themselves. So they're going to, my kids are so funny. Frankie comes up to me and says, Dad, I just want to be like Donald Trump. I just want a small loan for $1 million. And I was like, okay, well, you're not getting that. So, but I do want my kids to have the knowledge that they can go and build wealth, massive wealth, particularly at their age. If they can get into real estate early, I just told them, I said, look, get into real estate early, pop it all on 15 or 20 year AMs. And, in 15 or 20 years, you're going to have all these things free and clear, and you're going to be loving life. Now, my daughter, she wants to be a pastor. And so I said, look, you're probably not going to make a ton of money in that field. It's possible you would. You could write a great book or something.
Mega church.
Yeah, mega church, yeah. But she wants to be a pastor. And I said to her, it's really important that you learn to do some real estate investing on the side so that you can, you can have both the occupation you really want and your God-given talents, and then also you can start, building equity and making money and building long-term wealth. But I don't see any way to long-term wealth without real estate as a big factor in it, because it's the leverage. So
exactly,
I always say there's two ways to make money. It's you can leverage people or leverage money. And leverage people is building a business system, having the systems underneath you, and having other people doing all the tasks and everything for you, because there's a limit to your achievement. You can't do it all yourself.
Right.
But leveraging money, wow, you think about it. You just go to the bank, and all of a sudden they're giving you 75% loan to value on this property that they've never really seen. They just get an appraisal on it, and everything else is going along swimmingly, and you're just, starting to rock and roll, and you're making your cash flow after your debt payment. And
check your mailbox every day and cash your checks. And
it's a good thing. And then if things get a little tight, well, then just Airbnb it and get more cash flow. It just can take more, more of your effort.
But even that now, there's so many different things. We manage a few properties, and like the turnover B&B is a cleaning service that you can automate online. Yeah. Dynamic pricing, automatically adjust the pricing in real time. So, I mean, there's a lot of stuff that just seems like it comes out almost daily.
Yeah. Technology is ever changing on it. So,
yeah, but, the legacy really for my kids is, on this Thursday, I will take my kids to the one of the poorest areas of Lakeland, right outside of Talbot House Ministries, which is essentially a soup kitchen / overnight stay for the homeless. And I already contacted Talbot House and said, hey, I'm coming out with, I'm going to have about $2,500 in cash. We're going to give $20 in a Bible, or actually a small book of John, to all the folks that are staying with you that night. So we're going to be out there at 3:30 on Thursday of this week. And that's the kind of legacy I want to leave my kids, that they've been right. Yeah, sure. They've been flying around in private jets a lot of their life. The best one was my son, Frankie, when we used to fly around in private jets all the time back in the short sale riches days. And the amount of money we were making was just kind of absurd. But Frankie had only flown around in private jets, and he was really young. So he gets in this commercial aircraft. He says, Daddy, what are all these people doing on our plane?
That's a shock to the system.
That's amazing.
I said, just sit down, son. But anyway, Daddy, what are all these people doing on our plane?
No, that's awesome. But, giving them a good...
Yeah, they've got to have that foundation, knowing that, what are we really here for? And it's for other people. And so my hope is that they don't get all caught up in the money, but they use the money for the good it can do. And so that's what we actually have, a nonprofit. We just founded, a 501c3 called Bridge the Gap Lakeland. And the whole point of it is to help. We're not creating new services, but the problem in Lakeland is there's so many services available, but they're just not really coordinated. So if somebody needs, psychiatric meds, they need to go to Peace River Center. If somebody needs a bed to stay, they go to Lighthouse Ministries or they go to Talbot House. If somebody needs dental work, where do they go? If somebody, so we're just trying to let these services that are all available, we're trying to give more people access to them. So
that's good.
So it's kind of cool. And we've got a a friend of mine, Brian Nash, who used to be homeless himself, is one of our directors. He's on the board of directors of this new nonprofit. So I hope my kids will keep on keeping on with helping other people.
That's awesome.
Are you a native of Lakeland?
Yeah, born and raised.
Okay.
Yeah.
What has that meant for you to be able to give back so much to your hometown?
Sure. Well, that's special. That really is. And Lakeland, I tell you what, it is a philanthropic community. I mean, if you look at what has been done, just Bonnet Springs Park, which is 186 acre, I believe, free park to the public, which rivals Central Park. I mean, it's amazing. And that was the generosity of the Barnett family, but also a lot of other families in town. And I gave, a fair amount of money to it as well. But that's, open free to the public, and it's beautiful. And it really is something that just opened a few months ago. But Lakeland's got a lot of really very, very generous families and businesses that are headquartered there that really do pour into the community. So
yeah, there's a lot of history.
Publix, of course, is kind of the leader in their generosity. So they always win every award from the United Way and everything else, just because they're such a giving company. But yeah, I mean, I think my kids, I want them to know, when they went to Jesus and they said, Jesus said, well, I was naked and you didn't clothe me. I was in prison. You didn't visit me. I was, hungry. You didn't feed me. And they said, well, Master, when were you any of these things? And he said, as you have done it to the least of these, my brethren, you've done it to me. And so I want my kids, I mean, they all know that verse in the Bible. It comes from Matthew, but that's what I want my kids to learn, is that, who are the least of these, and let's give them a leg up.
Yeah, that's great. One of the things that we talk about a lot is sort of the entrepreneurial spirit that is so ripe in so many people and fun to watch, especially as you see the success and look back on it. Tell us a little bit about your path. I mean, I'm sure coming out of Georgetown Law, you had plethora of opportunities to go into good law firm jobs.
Sure.
Seems like you chose more of an entrepreneurial route and real estate focused. Talk to us a little bit about that.
Sure. Actually, it's funny that you mentioned that, because when I was finishing up my JD MBA at Georgetown, there was a class called Small Business Law. And so I took the class. It was Dean Everett Bellamy, who was a great guy, was the professor. And he gave us an option. He said, you can either do a business memorandum on small business law, which was a snooze fest, or you can do a business plan and actually create a business plan. And I was like, ooh, I'm doing the business plan. So I did this business plan for the class. And it was this idea of online investment advising. And this is back when, Al Gore invented the internet, So this is back in the day. This was in 1999, so a little ways ago. Or 1999 would have been the time frame I did the class. And so I did this class, and I did it, and I put it all on paper, and I did crunched all the numbers. And I thought to myself, I said, well, why do I want to go be a lawyer when I could do something like this?
Just do this business.
Just do this business. I just created it for the class. And so it was called smartportfolio.com. And truth be told, I did the business. And I did pass the bar exam, barely, but I did pass the Florida bar.
Well, what do they call a doctor with a C average? Doctor.
Doctor, exactly. So I passed the Florida bar and was very happy to do so, because I thought, well, I did go to law school. I might as well pass the bar and say I'm an attorney. That would be kind of useless to go to law school and not have the bar. But I did pass the bar, but I opted not to go work at Holland & Knight, which is the law firm here in Tampa that I was supposed to go work at. And I opted to do the business plan. And it was a great decision, because I got a couple other buddies of mine that kind of co-founded it with me. David Fogel, a real close friend of mine, and he was up at Sullivan & Cromwell, which is a huge, prestigious law firm up in New York City. And I would just call him every Saturday night at around 10 or 11, and he'd be working. And I said, you got to come down to Florida, have fun with us, and do this business with me. And he was the original investor in the company, and then he ended up coming in. He was the vice president of it. And so,
is this the one that you closed on it at that restaurant we ate at in New York
Balthazar.
City?
Yeah, we had our closing dinner at Balthazar in New York, and we sold. So anyway, the long story is smartportfolio.com sold in December of 2000. So it was just like we owned it for like 18 months. It was the startup, and we went from zero capital to selling for $7 million in 18 months.
Wow. And
so that gave me the real estate bug, because then I had some capital, and I thought, I've got some capital. I'm going to go start buying some real estate. But the other thing I always like to do, though, with real estate is buy with no money down, too. So that's always fun. Just I do it, not that I might have the money, But I would just rather do a no money down deal to protect the cash and to try to create another opportunity. There's a lot of that's going to go on here in the next couple of years. Yeah, subject tos and all wraparounds and all that. You gotta be careful when you do stuff like that. But there are legal ways to do it. But yeah, the entrepreneurial spirit just kind of got in me early. And then when the real estate market took the turn in 2008, 2010, I started this company with Nathan Jurwitz called Loss Mitigation Training Institute. We were traveling all over the country teaching people how to do it and really getting paid very well to teach people how to make money.
Good.
In a down market.
So those opportunities will be here.
They'll be here, my friend, but
they'll be here ahead of us, just not quite as bad as before.
Yeah, I don't think you're going to be going and buying 3-bedroom, 2-bath in good condition homes for $50,000 in Florida. But you'll be able to get some in the low 100s, I think.
Yeah.
So, and the money and the math will work just fine.
That's awesome.
Because rent rates have all gone up. I mean, dramatically compared to what they were. Rents aren't going down anytime soon.
Yeah, I would agree with that. I mean, some of these places in Tampa, like the Heron.
Oh, wild.
I mean, studio for like $3,500 a month. I mean, it's just crazy.
Yeah, it's crazy.
New York City prices, basically.
Yeah, exactly. Exactly.
Well, if anybody wants to go, is it on Amazon, your book? Yeah,
my book. Just go to Amazon, type in Chris McLaughlin, McLaughlin, just in your little search bar, and it'll pop up. I think it's like, Amazon regulates the price of it with supply and demand. I think it's like $9, and I'll make $1.
Oh, nice.
I'm gonna get
that can go towards that 100 million.
Exactly.
If we have 100 million subscribers and they all buy your book,
exactly.
You've already made it.
Yeah.
There you go. There you go, my friend.
Well, Chris, we appreciate you taking the time today. I think this was all really good information. And, our goal is, as we create this podcast and build subscribers, is just to help people, one, with current trends and things like that, but see from somebody with such huge success that, one, you're still very grounded, and two, you're an open book. You're kind of giving some of the secrets on how you can build this wealth, and we certainly appreciate you coming on.
Yeah, my pleasure. And I'll say everybody at the top.
Sounds good.
Thank you for joining us for another episode of the Legacy Wealth Code podcast. If you enjoyed this episode, click subscribe now and never miss an episode. Until next time, onward.